Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks to watch, economic news that'll guide stocks for the week. I highlighted real estate last week as the sector to watch over the next year, but warned there's still likely pain to come over the next few months, especially for the office and retail property groups. Stocks in the real estate sector slid 1.8% through last week to post the second worst performance among the 11 stock sectors. Even as the overall real estate market struggles to find that bottom, there is one part of the group that is hitting record highs and could further surprise for the rest of this year and beyond. I'm going to reveal why home builders are enjoying those record highs, the stocks I'm watching in this week's main topic. Stick around though. After that, we'll cover our Monday market update, the stocks to watch this week, and the economic news to highlight. If you want to see the stocks I'm buying for the next 30 years, my forever stocks, click on the link I'll leave in the description below. This is a free report I put together with the Motley Fool, my 5 forever stocks, the stocks following those biggest trends in the market. Just click through that link, you'll see the first stock immediately, then they're going to email you the next 4 stocks. Again, look for that link below in the description, click through, get your free report. It's absolutely free and it helps support the channel, so I appreciate that. Back to our main topic though, because a quick look at the residential real estate market doesn't present a pretty picture. Even on a median sales price that is down 7% from the last year, so home prices have fallen 7% over the last year. Surging interest rates means the cost of house payments has jumped 15% from last year, and home affordability has never been lower. And here we see that median sales price of houses in the United States reported by the Federal Reserve. Even on that drop in prices just over the last 5 months, the median home price is still double the 2009 low and up 26% since the pandemic. But what I'm going to show you today proves that the next real estate surprise could be a good one for investors. Part of the reason for that price resiliency, why prices went up so high and have stayed up higher even as the rest of the market came down last year, even as mortgage rates doubled in the last 2 years, is that homes available for sale remains at record lows. Housing inventory, that's the number of homes available for sale on the market, has been trending down since the housing bust and is now less than half the long-term range between 2 and 2.5 million homes available for sale. So right now, just over 1 million homes are available for sale, but the recent rate hikes over the last year are throwing a big challenge into that market. That's because the rate on the 30-year mortgage hit 7.2% earlier this month. That's the highest it's been in 2 decades. Most homeowners aren't paying that though. According to a study of 34 million mortgages by the Dallas Fed, only 30% of existing mortgages are above 4% and 95% are below 6% interest. That has led to a crash in the number of homes put on the market by sellers. And why sell your home and pay off a mortgage with a 4% interest rate if you're just going to have to go out into the market, buy a new mortgage at 7% rate? And the problem is especially acute in the higher end of the home market, with the number of sales of luxury homes down 24% in the second quarter versus last year. According to broker Redfin, inventory of luxury homes was down 2.4%, while the median sales price was up more than 4.5% for the quarter. That's a steeper drop than the 19.4% decline in sales seen in the overall market. So we are seeing that steep drop in the number of homes sold and the number of homes available for sale on the market. Of course, eventually lower rates could unlock some of that housing supply onto the market, but that could take years. If we look here on the CME FedWatch tool, great resource on the internet, shows market expectations for what the Fed is going to do in each of its meetings. And if we scroll down here, we know that the Fed funds rate, the Fed's target benchmark, is now at 5.5%. Okay, so it's 5.25% to 5.5%. The Fed's target bench rate for the Fed funds, upon which all other interest rates, including mortgages, are set after last week's rate increase at 5.25% or 5.5%. Now, according to the CME FedWatch rate tool here, we can see meeting probabilities. So we see each meeting over the next year, all the way through December of 2024. We see in blue here the preponderance of the odds. Okay, so what the market expects, the highest odds the market expects at that different rate. So where the market expects the Fed to increase rates, to cut rates. After that last meeting last week, we do see that the market does not expect the Fed to increase interest rates again. Their next move should be to cut interest rates, but that could be all the way in May of next year before they cut interest rates. The market expects the Fed to keep interest rates right here at 5.25% to 5.5% all the way through March of 2024. What we do see, though, is that after that, it sees the Fed aggressively cutting rates to support the economy as the economy slows down from this historic 40-year hit in interest rates. all the way down to 4.25%. So we see here by 12/18/2024, their December 2024 meeting, the Fed is expected to have cut rates down to 4.25%. Now, the problem with that is that expected 1.25% cut in rates isn't going to go far against a 5% increase over the last year in interest rates. The fact is, we could be looking at higher mortgage rates for a very long time, locking up that 95% of the residential real estate market and further dragging down those available homes for sale. The only solution here to that severe housing shortage is going to be to build ourselves out of it. Now, shares of home builders have already boomed on higher home prices over the last 2 years. Here we see the XHB, the Spider Home Builders ETF, up 40% this year and double since the pandemic, but could see a wave of demand as new homes become really the only supply available on the market. And as we look at profitability for these home builders, while wage inflation is still an issue, the price of lumber has dropped back down to pre-pandemic levels from its jump in 2021, and home builder profitability is looking better. For the research here, I created a quick table of fundamentals for the 6 largest home builder stocks to compare the valuations and growth. We do see the 6 home builders here: Pulte Group, ticker PHM; Lennar, ticker LEN; DR Horton, ticker DHI; Toll Brothers, ticker TOLL; Beazer Homes, ticker BZH; and KB Home, ticker KBH. Here at the top, I've got their market cap, so their comparative size, market size, the price to earnings ratio, PE ratio, their price to sales, enterprise value to revenue, earnings growth expected, and then operating margin over the last year. So very important there. How much are we expecting earnings to grow for each of these companies? We do actually see that that's negative, so we'll talk about that. The operating margin, that core measure of profitability for these companies. Now, here we see Pulte Group, here ticker PHM, and DR Horton, DHI, have the highest operating margin, meaning management has really dialed in that ability to turn revenue into profits. Okay, the operating margin is the operating income over the revenue. Okay, so operating income divided by revenue divided by sales there. So it gives you a measure of how well management is paying their supplier costs, paying their operating expenses, and turning those sales into operating income. Now, DR Horton here does suffer from the expectations of a decline in earnings along with most of the industry. So we do see that most of the industry does look like it's going to have a earnings drop, so a decline in earnings over the next year. It has come off of a very strong period for home building. The market does expect to see lower sales prices and higher rates, really affecting the business. While earnings are not likely to jump, the demand for new homes should help home builders surprise on the upside. So what I'm thinking here is that even if mortgage rates stay high, even if home affordability stays low, then just the fact that we are not putting more houses on the market other than the ones we can build. So these home builders are going to see very strong demand for building new homes. They're going to be able to translate that from sales into profits, and I think they're going to surprise what a lot of people are looking at. Pulte is one of the only 2, along with Toll Brothers, ticker TOLL, really here expected to grow its earnings over the year. So Pulte here we see is expected to post 7.6% earnings growth. Toll Brothers expected to post 6.2% earnings growth. The rest all double-digit earnings declines expected over the next year. It's really making Pulte there my favorite among the 6 companies. That's on a low valuation. You can see here Pulte trades for about 7 times on a price to earnings basis, 1.13 times price to sales. It's not the lowest of the group, but that combination of high operating margin, so high profitability, earnings growth, and then fairly low valuation makes it really my top pick for the group. KB Home, ticker KBH, is also expected to see its earnings plunge 29%, but is trading attractively on that valuation basis and could easily beat on expectations to help the company outperform. I want to talk about some of the other stocks I'm watching this week. Going to be a very busy week for earnings. A lot of companies reporting their second quarter earnings that could be very volatile around specific companies. One of them, Devon Energy, ticker DVN, has really followed the energy sector into weakness this year, but still pays an attractive 8.5% dividend yield. While I am positive on the energy sector, we've been talking about this over the last couple of weeks. Oil prices hitting $80 a barrel last week. Energy sector come roaring back over the last month. And I do believe cash flows will more than support the dividends for a lot of these stocks. I do worry that management here with Devon Energy may warn about kind of stricter cash management when it reports earnings on Tuesday. The broader energy sector pays an average 4% dividend yield, so For Devon to pay out more than double that yield really implies some level of capital destruction unless management can just outperform its peers by a wide margin. I like Devon Energy. I like how it's run. I like the profitability. I just don't know that it's able to produce that kind of return on equity to be able to pay out a double dividend yield over the rest of the sector. Devon is still one of my favorite names in energy, so I would be a buyer on any big dips in the shares, and will be watching it on Tuesday. Teva Pharmaceuticals, ticker TEVA, it's going to be reporting its earnings on Tuesday as well, and it remains one of my favorite value plays here. And the company has put its litigation problems related to the opioids behind it and is quickly paying down debt to the tune of $1.3 billion a year. And the company still has a high debt burden, but shares trade for an unbelievably cheap 3.7 times earnings. Okay, expectations are for sales growth to remain around 1% a year, but management has refocused on that growth strategy and could surprise higher. Even on flat sales growth, though, here, the valuation puts a floor on the shares of around $7.50 a share, with a fair value closer to ICC at about $10 or $12 a share here. Another stock I'm watching here, PayPal Holdings, ticker PYPL. It's one of the few forever stocks that hasn't taken off this year, with the shares really flat since January. While there's no doubt competition is building up in the industry, especially with Apple Pay, the stock seems to be at a peak fear amount, and PayPal still holds a strong share of that payments market. Earnings are expected 20% higher this year to $4.95 a share. That puts the valuation at a very low 15 times PE for this company. I think the downside is limited here, and any new growth news or initiatives could really help boost these shares. Going to be a lot of big stocks reporting their earnings this week, including Amazon, ticker AMZN, and Apple here, ticker AAPL, both going to be reporting their earnings later on in the week. Shares up 55% so far this year and kind of looking a little stretched on valuation. I'm particularly worried about here Apple trading at 32 times PE ratio and expecting sales to actually decline 2.4% this year, only to recover 6.7% sales growth next year. So analysts not positive on the sales growth this year and next for Apple unless it can come up with any kind of new product that really energizes this stock. Again, the company is going to need to talk up some kind of a growth driver that can bring back sales growth, or the stock could see weakness similar to Microsoft's drop last week. Give us that big picture with the sectorspiders.com sector tracker here. Great way to give us that big picture, how the stocks in each sector did. We do see that 7 of the 11 stock sectors closed higher last week, with really those rate-sensitive sectors falling on that rise in the 10-year Treasury. So last week, the 10-year Treasury bond went from 3.84% the previous week to almost 4% last week. There's a big rise in interest rates. These sectors, like utilities, like real estate, like consumer staples, are really sensitive to those interest rates on two fronts. And first, as dividend investors really sell out of those stocks for safer and higher yields in bonds. So when interest rates in bonds rise, dividend investors, income investors in a lot of these stocks, they look to higher yields in those bonds and say, hey, you know what? I don't need the risk in stocks. I can get just as high of yields and income from these bonds. And so they kind of exodus out of a lot of these rate sensitive names in utilities, in energy, in real estate, and in consumer staples. Also, though, second, because of the higher debt used in operations with these companies, especially real estate, utilities, consumer staples, very cash flow stable sectors. So they tend to use a lot of debt in their operations. Of course, with higher interest rates, that means higher interest expense when those rates rise. As discussed last week with real estate, these sectors could get a boost when the Fed does eventually start cutting rates as expected early next year, but that could be a big wait for investors. Looking a little bit further out over the year-to-date picture here, with the S&P 500 up nearly 20% this year, along with stocks in technology and communication services up more than 43%, I wanted to revisit valuations for each sector. Now, of course, stocks don't fall just because they get expensive, and the bull market is still relatively healthy, but valuations are stretched in several of these winning sectors. So I wanted to look here at the FactSet Earnings Insight. All you out there in the nation know this is one of my favorite resources. Really tracks earnings and valuations in each sector. Stocks in the technology sector. Here we see the S&P 500 sector level forward 12-month PE ratios. So this dark blue bar here is the current PE ratios for each sector, for stocks in each sector. So for example, information technology, the blue bar there, trading for 27.4 times PE ratio. That means the stocks in the technology sector are trading for a price of 27.4 times the expected earnings those companies are going to report over this next year. Great valuation tool here to see which sectors are relatively more expensive and which ones might be your value sectors there. So according to FactSet Earnings Insight here, the stocks in the technology sector are trading for that 27.4 times their expected earnings. That is 41% higher than the long-term average. You see the long-term average here in green, the 10-year average of 19.4 times PE for that sector. Other relatively expensive sectors here include consumer discretionary. It's trading at 15% more expensive at 26.1 times PE. You've also got materials here trading at 10% more expensive than that 10-year long-term average. The S&P 500, the market index itself here, trading for 11.5% premium, 11.5% more expensive, trading at 19.4 times versus an average of 17.4 times PE ratio over that 10-year period. So stock market as a whole trading relatively expensive here after that big run this year, 20% so far this year. Cheaper sectors, on the other hand, include utilities. We just talked about 1% discount to average. So you see utilities here trading for 17.3 times on that PE basis versus a 17.5 times long-term average. So utilities are actually trading under that long-term average. We also have energy here trading at 24% discount to the average, and real estate. We talked about real estate last week. Again, it's the sector to watch, I believe, over the next 2 years as interest rates get cut and those properties get revalued higher. It is now trading at 12% discount to the long-term average. Going to be a relatively light week for economic news, apart from all the earnings coming out from companies until we get to Friday's jobs report. That's expected to show 200,000 jobs were created in the U.S. last month. That'd be versus 209,000 jobs in the previous month. So jobs market still actually very strong. The unemployment rate is expected to stay at 3.6%. Hourly wages expected to post the same 4.4% annual growth. Those would both be the same as the previous month. So really expected no change in the jobs market over the last month. While the report may show that the jobs market is still surprisingly strong, so I do believe we could get a higher than expected number there. It's probably unlikely to really affect the market much unless we see a very high or a very low report. Get your free report, My Forever Stocks, by clicking on the link in the description below. Or click on the video to the right for the fastest way to live off your dividends. And I guarantee you this is not the answer you're expecting. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.